Hey guys, it's Matt at Deal Camp, and I want to talk about asset purchase agreements versus stock purchase agreements. And just make a quick little video on this. And I looked around. I'm not an attorney. I cannot advise you on anything legal. I can't give legal advice, and nothing that I'm saying here is legal advice, by the way. But I did find an article that lays it out pretty clearly, and so I wanted to walk you through just some of the differences and give you a lay of the land of this as you're going about your deal. And so the first thing that I'll say is most small business transactions are asset purchase agreements. Um, if you talk to any attorney out there who is actively helping people acquire or sell small businesses, they're going to be familiar with that. And so there are reasons why a seller might want a stock purchase, but the asset purchase is typically what most people choose for a bunch of different reasons. So let's kind of get into this. I was able to find, I went and looked at lots of different articles out there just to see if something boiled this down to a really simple explanation of the difference between asset purchase and a stock purchase. And on findlaw.com, there's a pretty good article about it. And I wanted to just quickly walk you through this is, whenever you buy a asset from somebody, like, let's say that you're going to buy a car, it comes just with that thing that you bought. So like if you go buy a car from somebody, you don't drag along with it the note payment for that typically, right? And the same kind of thing applies uh, with buying companies. Is the great thing about an asset purchase is that you basically get to specify the liabilities you're willing to assume according to this website, because I'm not an attorney, I can't tell you that. So the great thing is you can have a document that I might pull up here in just a minute, but it'll say we're buying these specific assets, and we're not taking on any liabilities except for what is listed in Appendix A. And Appendix A will say maybe blank, maybe nothing. Or it may say advanced deposits. Well, we're willing to take on that liability, or warranty liability, or something like that. So this is a negotiated point, and it's really useful because if you check out our video on due diligence, you'll kind of see there's a lot of stuff, that can transfer over to you and end up costing you money if you do a stock purchase. So if you check out that video, you'll hear me tell a story about how I kind of lost my shirt on one of those deals and why I think due diligence is like really, really critical and underappreciated by searchers. So anyway, with the stock purchase, the reason why a seller might want that is because of the tax consequence. So and they may want you to take on liabilities for them as well. There may be some reasons for that, but whenever you're selling a business, if you sell the stock, the appreciation of the stock is what you pay taxes on, right? If you sell the assets, then basically the difference between your basis and what you get for those assets gets you pay capital gains tax on that. For a company that has like a lot of equipment and a lot of hard assets, they may have bought all that stuff over years. And let's say that the company's got $10 million worth of equipment. Well, it may have gotten written down to zero. And so now whenever, not only have you you've put in this money, you've gotten the tax benefit from it, and now you're turning around and your basis is zero and you've sold the business for a higher price. You've got to pay the difference on that. So there's usually like a tax difference, consequence. And that's where some negotiation can help you kind of navigate that. and there's some room for creativity in that because of it. But most people don't get cute about it. Is they say, hey, I'm comfortable with the assets. I would rather pay you just a little bit more money if you're really worried about the taxes, just to be able to do the asset purchase, because I have no idea what skeletons are buried in your closet, and I want to avoid that. So that's some of the big key parts of the asset purchase agreement. If you want to learn about it, you can quickly Google it on findlaw.com. There's this cool side by side visual that kind of helps you through it. Okay, so the other thing with asset purchase agreements is you're going to line out a couple of things, and your attorney will advise you on the best thing to do. Everybody's got their flavor of deal that they like to do, but typically in small business world, you're going to have some amount of money down, and then you're going to have some kind of money at risk. And the money at risk is typically the money that is, it might be blue sky. It might be, maybe you can't come to an agreement on valuation, and so there's some type of earnout. Maybe there's a seller's note in that helps you kind of bridge the gap with that valuation. But whatever that at-risk piece is, that goes into the document, it lines it out. And so as you're going through this negotiation, one of the things that happens is you have to have a conversation to say, okay, your earnout's going to be structured as 1% of sales. This is an example. 1% of sales on all revenue, or it's 5% of sales on revenue above a certain threshold, or you've got a owner's note and it's going to be a 7-year amortization, and I'm going to pay you a 7% interest rate. And so all of that gets lined out in really clear language, and it makes it really simple for you and the attorney and everybody to dig through it and understand, what are we talking here? What's the structure? You're typically going to have working capital adjustments based off of how things change throughout, prior to closing, where they're at the day that you're handing over the keys. There might be an adjustment for working capital because they brought on a ton of working capital, and that's the additional value that you're getting. So you might have to pay a little bit more money. All of those things happen leading right up to closing. So unless you understand what's going to go into the asset purchase agreement, you kind of don't know what to expect at closing and how things can kind of shift on you. And so a good attorney is going to be really critical for you as you're going to close your deal. You shouldn't buy a business. Some people will try it, but I wouldn't buy anything without the help of an attorney, just because there's so many different ways that you can lose your shirt and get taken advantage of, honestly. I know there are other people who teach that, but I don't think that's wise. So you're going to have all the terms. You're going to have everything that you're purchasing. And there needs to be some kind of mechanism whenever you close that deal to say, hey, this is what we said that we were going to buy. Let's go through and take an inventory of everything that whenever they hand you the keys, let's go through the building and make sure that everything's here. And if it's not at that moment, then you've got some kind of recourse, and that's where that money at risk comes from, is sometimes you can pull it from there. So I won't get too deep in the weeds on this video. It's just to give you an overview of the asset purchase agreement versus a stock purchase agreement. And just to let you know, in the world of small business acquisitions, stick to, consult your attorney first, but I tend to stick to a stock purchase agreement. And I typically employ a solid, experienced deal attorney who understands not only the language and the risk factors that I'm trying to adjust for, but also the negotiation and the back and forth between the seller, because it's one of the ways that deals get crushed. So with that, I hope that was helpful. Quick overview. Check out FindLaw and check out our courses at courses.dealcamp.com if you want to dig more into like how to do these deals. And we'll see you in the next video.